Assalamu alaikum. I am Rafia Jahan from the Department of Finance at the University of Rajshahi. My student ID is 231253615. Today I will be presenting a strategic overview of the monetary policy statement for the first half of fiscal year 2025 to 26 issued by Bangladesh Bank. Let's explore how this policy is designed to tackle current economic challenges and guide the country toward stability and growth. Then, next slide. Before I explain this policy in detail, let's quickly understand what monetary policy actually means. The process through which a country's central bank like Bangladesh Bank manages the money supply and interest rate. The goal is to achieve key economic objectives like controlling inflation, stabilizing the currency and supporting growth. Then move to the next slide. Now that we know the basics, let's look at a short preview of the monetary policy statement for first of fiscal year 2020 to 26. The latest monetary policy statement outlines a strategic plan to stabilize inflation and manage external shock. Bangladesh Bank continues with a tight monetary stance, aiming to restore macroeconomic stability and addresses weaknesses in the financial system. The policy also introduces tools and reforms to tackle persistent inflation and global economic pressure. Then, next slide. This policy is guided by a few clear objectives. Let me highlight the three most important ones. First, price stability. It's aimed to reduce inflation to 6 to 7% by the end of fiscal year 26, making goods more affordable for consumers. Then, exchange rate flexibility. Bangladesh Bank is shifting to a fully market-based exchange rate system which will improve competitiveness and transparency. Then financial system confidence. Reform in the banking sector are focused on reducing non-performing loans and improving governance to build trust and stability. Then move to the next slide. To achieve these objectives, Bangladesh Bank has adopted a particular stance. Let's see what that stance is. The policy adopts a contractionary stance, meaning it's tightening the money supply to control inflation. Key interest rates are repo rate at 10%, SLF at 11.5%, STF reduced to 8%. These elevated rates help anchor inflation expectation and encourages saving and investment in safer financial instruments. The next slide. Having understood the stance, the next question is what tools does the central bank use to implement it? Let's find out. Interest rates like repo, SLF and SDF influence short-term borrowing and liquidity. Then open market operation help manage liquidity by buying or selling government securities. Then reserve requirement like CRR and SLR control how much money bank can lend. Then targeted refinance scheme support priority sectors such as agriculture and small medium enterprises promoting inclusive growth. Then next slide. Policies don't remain the same every time, so how is this one different from the last? Here are the key changes. Let's compare to the previous policy. The inflation target is now more ambitious, revised from 7 to 8% to 6 to 7%. The private credit growth is reduced from 9.8% to 7.2%, showing a tighter approach. The exchange rate system is transitioning to a fully market-based regime, aiming for better stability and transparency. The next slide. But even with these changes, the economy still faces some major challenges. First, persistent inflation, driven by supply issues and global price hikes. Then currency depreciation, which increase import cost and affect the balance of payment. Then banking sector vulnerabilities, including high non-performing loans and weak governance, a strong need for institutional reform and better coordination between fiscal and monetary policies. Then move to the next slide. To overcome these challenges, some policy suggestions are given. Fiscal monetary synergy, aligning government spending and tax policies with monetary goals. Then banking sector reform, making the banking system more transparent and reducing bad loans. Then export promotion, offering incentive to diversify export and strengthen foreign reserve. Then implementation requirement, success depends on a strong political will, institutional capacity and collaboration among all stakeholders. The next slide. In conclusion, the half first of fiscal year 2026 monetary policy emphasizes a tight framework to ensure price stability and sustainable growth. Its success depends on effective implementation and institutional reform, proactive risk management, and alignment with fiscal policy are key to long-term development. A disciplined and transparent monetary environment will help build investor confidence and support economic recovery. Thank you for watching.